Okay, now let's define all the variables and what are the definitions. Okay, table 5.3 presents the definitions of the variables used in the empirical analysis. So the first one is the delta percent. Delta percent. What is delta percent? Delta is the variation in the value of the portfolio of derivative products for every $1 variation in the price of gold. Okay, the delta is the variation in the value of the portfolio of derivative products. Is the variation. The delta is the difference between one measure to the other, variation in the value of the portfolio of derivative products for every $1 variation in the price of gold, because this is the underlying asset. Underlying asset is gold, the price of gold, and the difference, the delta, is the variation in the value of the portfolio of derivative products for every $1 variation in the price of gold. This value, calculated quarterly is measured by the ratio of the sum. It's measured by the ratio of the sum of ounces of gold to produce during the next 3 years for which the price is hedged. This value, calculated quarterly, is measured by the ratio of the sum of ounces of gold to produce during the next 3 years for which the price is hedged, divided by the total anticipated gold production for the next 3 years. So, okay, so measured by the ratio of the sum of ounces of gold to produce during the next 3 years for which the price is hedged. So I sum everything which is hedged, and then I divide by the total anticipated gold production for the next 3 years. And the delta percent measures the level of derivatives used, that is the degree to which risks are managed. That is the degree to which the risks are managed. So depending on different ways of hedging, I take my delta. Table 4.2 provides the distribution of the delta percent calculated. Let's go to table 4.2, in which we calculate the delta. The delta is, okay, we have these derivatives. We hedged 96,000. We have the delta. We have the gold loans payable. We have the gold loans payable 92, gold loans payable for 1993, the put options maturing in 1991, and call options maturing 1991. Here we have the number of ounces and the delta hedged. So how many shares, or how many of this value did we hedge? So this is 0.003 minus 0.957. So delta ounces. So this is what we hedged with negative aggregate equivalent portfolio position in ounces, production estimate through 12/13. Okay, this is the production estimate for the 3 years, and if this is what we hedged in 3 years, we have approximately delta percentage, the percentage of production accounted for by portfolio delta is 21%. It's 21%, and we have the delta B. delta equals -1 for short forward and embedded forward positions, and C is delta, C here is delta times number of ounces to get a nice number of ounces, because we need to divide by the total number of ounces. Okay, let's see what else we have. Now, in the definitions we have this other term. This other term is market value. The market value. What is the market value? Is defined. The market value is defined by the number of common shares multiplied by their unit market value at quarter end, plus the number of preferred shares issued multiplied by their value at par, plus the book value of debt in US dollars. Okay, I will repeat. The market value is defined by the number of common shares multiplied by their unit market value at quarter end, plus the number of preferred shares, okay, preferred shares issued multiplied by their value at par, plus the book value of debt. So that is the market value of the firm. Market value of the firm. So it's equity plus book value of debt. Okay, that is here. This variable is used to scale many variables. Yeah, because we have the leverage ratio. It's long-term debt divided by market value, but market value is common shares multiplied by the unit market value at quarter end, plus the number of preferred shares issued multiplied by their value at par, plus the book value of debt. So this is nothing else than the value of the firm, or the value of assets of the firm, like is equity plus debt in the balance sheet. This is the total sum. This variable is used to scale many variables. There are fixed components in both the costs of financial distress and in the costs of implementing a hedging program. There are fixed components in both the costs of financial distress. For example, in the leverage ratio, if a company has a very high leverage ratio, cost of financial distress, that means a long-term debt divided by market value is a high number, we are at risk of financial distress. And in the costs of implementing hedging program, we also know that the firm size is also a measure that can be viewed by the market value of the company. For a large firm, the relative costs of financial distress are smaller, which means that the firm requires less hedging. So for a large firm, the relative costs of financial distress are smaller, which means that the firm requires less hedging. For a small firm, the relative costs of financial distress are larger, which means that the firm requires more hedging. So small firms have larger cost of financial distress, so needing more hedging. Conversely, the entry barrier to implement a hedging program is smaller. We said that for firm size, it's ambiguous, because the larger the firm, it should need less hedging. And also, we said that the firm size is a control variable for firm ability or firm capacity to access or to develop risk management activities, and that's something we have. That's something we saw. Okay, so now, okay, to complement this market value, we say that firm size is a control variable that can be an indirect measure of the financing costs, and also this variable can also measure the firm's ability to access different risk management methods. Good. In the maximization of the firm, reduction of anticipated costs of financial distress and premium to partners, we have also proposition 3. Let's go to proposition 3. What is that? We have long-term debt divided by market value. We already know that market value is nothing else than number of shares multiplied by the value of shares, preferred shares multiplied by value at par, plus book value of debt. The book value of the long-term debt divided by the firm's market value. Debt generates interest payments, and principal repayments. If the firm is unable to make these payments, it may experience financial distress. This ratio therefore captures the financial distress factor. A positive sign is predicted. Okay, the ratio, the leverage ratio, which is long-term debt divided by market value in proposition 3. Let's recall that proposition 3 says what? Says that companies with high average production costs and that are more heavily indebted over the long term should practice more risk management to reduce their anticipated costs of financial failure. So here we are, okay? The variable measured as long-term debt divided by market value is captures the financial distress factor, and it has a positive sign. So the higher this value of long-term debt divided by market value, in proposition 3 we have the higher this ratio, the higher the higher the hedging should be. The risk management should be more exercised. Cash costs is the average production costs. Average cash costs in US dollar to produce 1 ounce of gold. The variable is repeated in the 4 quarters of each year because it is available only on an annual basis. Production costs determine the firm's productivity. They thus capture the short-term financial distress factor, and a positive sign is predicted. Proposition 3, just remember that companies with high average production costs and that are more heavily indebted over the long term should practice more risk management to reduce their anticipated costs of financial failure. Cash costs. The higher the production costs measured by cash costs, the higher the delta percentage. The higher the delta percentage, which is the hedge ratio, hedge percentage. Okay, let's go on. 5.32, maximization of firm value. Proposition 4 is proposition 4. Dividend ratio of dividends announced. let's recall what proposition 4 is. Firms in good financial health meaning that announce dividends and finance their investments with preferred shares, have a lesser need to external debt and consequently need less hedging or risk management to protect themselves from the costs of financial distress. So another measure of financial distress, cost of financial distress, is the dividend ratio. This ratio represents the annual per share dividend announced dividend by the share price at the end of the quarter. By announcing a dividend, the firm promises to pay said dividend in the future. To ensure that it can pay the dividend, it should practice hedging. To ensure that it can pay the dividend, it should practice hedging. A negative relationship is thus expected. If if you announce payment dividends, you should practice hedging. A negative relationship thus is expected. If you don't announce dividends, you should not practice hedging. This ratio can also be a good indicator of the firm's financial health, which reduces the need for hedging. Okay, so in the end, maybe this is ambiguous, because to ensure that it can pay the dividend, it should practice more hedging, and a negative relationship is thus expected. This ratio can also be a good indicator of the firm's financial health, which reduces the need for hedging. Now, for the use of preferred shares. Preferred shares divided market value. This is a ratio. The use of preferred shares to finance investment. And we said that the number of preferred shares issued multiplied by the value at par and then divided by the firm's market value, the number of preferred shares issued, what is it? The variable is, well, the number of preferred shares issued multiplied by the value at par and then divided by the firm's market value. The preferred shares is a substitute for external financing that is more flexible than debt. Because payment of dividends is optional, and interest and capital principal repayments of debt are obligatory, are mandatory. So, given that that an increase in the total value of preferred shares generally translate into a reduction in the ratio of indebtedness, a negative relationship is expected. Notice that a reduction in the ratio of indebtedness, a negative relationship is expected for this variable. Negative, right? Good. Now let's go to proposition 5. Increase in investment possibilities. Increase in investment possibilities. We have the two variables to measure proposition 5. Proposition 5 says firms with more investment projects should hedge more, but this effect may be weak for firms having natural sources of diversification. Let's see what's this about, what this all about. Acquisitions divided by market value is the measure. Okay, as for example in preferred shares, the use of preferred shares is divided by market value. To standardize, we said in the market value, this variable is used to scale many variables. So we scale the long-term debt, okay, the leverage ratio. We scaled the preferred shares, market value. We scale the acquisition. What is acquisition? What is the variable? Acquisition divided by market value. The value of acquisitions announced during the quarter and aimed at firms in the same sector. The value of acquisitions announced during the quarter and aimed at firms in the same industry or sector divided by the market value. This is very important. And the variable captures the investment opportunities factors. Just remember that we are looking at the maximization of firm's value. Remember, we have reducing the expected costs of financial distress, reducing the risk premiums payable to various partners. Remember that probably this is the cost of production is measured by risk premiums payable to various partners, and expected costs of financial distress could be measured by the leverage ratio, which is long-term debt divided by market value. And now we have in the third determinant of risk management activities, which is increasing investment possibilities. We have acquisitions. When we have acquisitions, what happens? A weak positive relationship or even a negative relationship is presumed because the correlation between investment opportunities and cash flow is generally positive in the gold mining industry. Example, or that is gold producers benefit from natural hedging. A weak positive relationship, maybe if you have acquisitions in the same industry, you will need a little bit more of hedging, or sometimes if you benefit from natural hedging, even the relationship can be negative because the correlation between investment opportunities and cash flow is generally positive. So more investment opportunities, more cash flows. So in more cash flows, more cash at hand means less need for hedging. Then for this increase in investment possibilities, we have exploration expenditures. It's also important here. So we say that exploration expenditures divided by market value, scaled by market value. Exploration expenditures divided by the firm's market value. The variable is repeated for quarters, for the 4 quarters of each year, because it is available only on an annual basis. The variable captures the growth opportunities factor to the extent that exploration efforts are profitable. The variable captures the growth opportunities, or the investment opportunities, growth opportunities factor to the extent that exploration efforts are profitable. A weak positive relationship or even negative relationship is presumed because the correlation between investment opportunities and cash flows is generally positive in the gold mining industry. Gold producers benefit from natural hedging. So it is exactly the same. Acquisitions may increase the cash flows, thus posing a natural hedge, and here exploration expenditure divided by market value is also can even have a negative relationship, and the correlation between the investment opportunities and cash flow is generally positive. So more exploration expenditures may lead to more cash flows in the end, and thus meaning that we need less hedging, or maybe a weak positive relationship as well as acquisitions. Okay, that is the third justification of risk management in a company. in terms of maximization of firm value, reducing costs of expected cost of financial distress, reducing the risk premiums payable to various partners, and increasing investment possibilities. Hedging increases investment possibilities. And now let's go to the fourth one of maximization of firm value. We say that reducing expected tax payments. This is the fourth part. Proposition 6 says that firms with convex local taxation structures should undertake more risk management activities. Okay, so we know that. How do we measure that? Okay, we have two ways: tax save. This variable measures the real tax savings as a percentage following a 5% drop in the volatility of profits. This variable measures the real tax savings as a percentage following a 5% drop in the volatility of profits. It does not measure the degree of convexity directly. It doesn't measure the degree of convexity directly, but at best may indicate that the function is convex if it is positive, or concave if this is negative. If it is negative. Values are given in table 4.3. So now maybe if we go to table 4.3, we will find this. These values. All right. Now, deferred income taxes assets. The deferred income item of the statement dividend by total assets, given that tax credits for losses reduce deferred income. The ratio measures the inverse of the tax function's convexity. Okay, deferred income taxes divided by assets. Okay, the deferred income item of the statement dividend by total assets divided by total assets. Given that tax credits for losses reduce deferred income, the ratio measures the inverse of the tax function's convexity. We consequently predict a negative relationship to these deferred income taxes, which is in fact is a credit. If we have more credit in payment, so we consequently predict a negative relationship. If we don't save that much because we have deferred income taxes, we will hedge less. If we have deferred income taxes, we hedge less. In our computations, this variable was selected because it was available on quarter basis, unlike the tax credit available. Here we have a note for this. Tufano uses the variable tax losses carry forward as a measure of convexity. For firms' tax function, a positive sign is predicted, but it is not evident that the variable clearly measures the convexity of a tax function. All right. Excellent. Now let's go to proposition 7, which is firm size. We only have 1, 2, 3. We only have 3 more propositions. Let's go quickly over these ones. For example, proposition 7 says that firm size has an ambiguous effect on the level of risk management. And we also say that firm size is a control variable that can be an indirect measure of the financing cost. This variable can also measure the firm's ability to access different risk management methods. Most empirical studies show that large firms use more hedging, although it is the smaller ones that would need it the most. Proposition 7 says firm size has an ambiguous effect on the level of risk management. And we have two variables to measure this. One is market value, and we already discussed market value, and also the reserves. The more gold reserves a firm has, it's supposedly a bigger firm reserves. The firm's proven and provable gold reserves in ounces at year end as a measure of firm size. The variable is repeated for the four quarters of each year because it is available only on an annual basis. Similar to the market value variable, reserves offer to theories related to the cost of financial distress and to hedging costs. The sign is indeterminate. So, okay, reserves is proven and provable gold reserves in ounces at the year end as a measure of firm size, and it is available only in annual basis. Okay, good. And we already discussed market value, which is the number of shares, common shares multiplied by the market value, preferred shares multiplied at par value, and book value of debt. Good. Now, other variables discussed in the literature are financial constraint, and then we have the proposition 8, which is firms with tight financial constraints have a greater need to hedge from price declines to be able to pay their debt and satisfy their other financial needs. Firms with tight financial constraints have a greater need to hedge from price declines to be able to pay their debt and satisfy their other financial needs. So proposition 8 is financial constraint. It's a binary variable that equals 1 when the long-term debt divided by market value, so the leverage ratio variable, and the liquidity ratio are respectively above and below the industry median. So when the leverage ratio, long-term debt divided by market value, is above the industry median, and when the liquidity ratio is below the industry median, the binary variable or the dummy variable takes 1. But let's look at liquidity ratio. Liquidity ratio is the sum of cash on hand, short-term investments, and accounts receivable divided by short-term liabilities. Short-term debt, short-term liabilities. The sum of cash on hand, three things: cash on hand, short-term investments, and accounts receivable divided by short-term liabilities. And otherwise, we say, coming back to the financial constraint, otherwise it is equal to 0. A firm with high indebtedness and a thin liquid cushion is a firm operating within the limits of financial constraint. The variable captures the financial distress factor, and a positive sign is predicted. If you have, the more financial constraints you have, the more you want to hedge. And we already talked about proposition 9, liquidity ratio, which is the sum of cash on hand, the short-term investment, the accounts receivable divided by short-term liabilities or divided by short-term debt. Liquidities act as a cushion for financial losses. They are thus substitutes for risk management, and a negative relationship is expected, meaning that the more liquidity ratio, the higher the liquidity ratio, the less need for hedging. And this is the conclusion of the proposition. Okay, before we say, okay, proposition 9 is said that we predict a negative sign for the variable liquidity ratio. And that's it for the propositions combined with the definitions of the variables. Good.